All right, good evening, guys. Welcome. Please let me know if you can hear me clearly. Just want to make sure everything's tuned in. Everyone can hear me clearly, so give me a thumbs up if you can, please. Welcome to this live session this evening. I just want to open up and just say thank you to everyone who came to the last one where we had a pension-focused Q&A with Pension Bee. The feedback from that was really good, and it's going to be the first in what will be almost like a series of live sessions that will be focused on very specific topics. So I really do appreciate everyone who actually came along to that. And this evening, happy to take any questions. A couple of things I do want to just mention beforehand. We are closely approaching the end of the tax year, which means that on April the 6th, we're all going to get an extra £20,000 into our ISAs, or the ability to pay £20,000 into our ISAs. Now, ISAs typically form a huge or a common theme in a lot of the questions that I get here. So what I'm planning to do is to essentially do a workshop specifically on ISAs. Now, within this workshop, we will cover pretty much everything you need to know about ISAs specifically. So we're going to cover what they are, how they basically work. We're going to cover the kinds of ISAs that you have available to you, how to actually use them, where they fit within a financial planning structure, why they're so important. And we are going to go through the ISA rules. The rules are really important to make sure that you get a grasp of them, because you don't want to, break the rules and have to report to HMRC that you've double contributed and so on and so forth. So that workshop is going to be next Saturday. I'm dedicating 2 hours. The content will probably take maybe around about an hour, maybe an hour 15. Then we're going to leave 45 minutes for questions. You can ask as many questions as possible, but the idea is that the workshop is going to give you pretty much everything that you need to know in a comprehensive manner, so that with the tax year about to end, you'll know exactly what you need to do and exactly how things work moving forward as well. So if you are, looking at the tax year at the moment and you have questions about ISAs, that will be a really good session for you to sit in at. It is going to be hosted on Zoom. Tickets for that are $19.99, so you can book tickets straight away if you so want to attend. So with that being said, that's pretty much it. Let's have a look and see what we've got in the chat, and see if we get any questions that we can get through immediately. As always, guys, I'm going to dedicate a little bit of time to this today, so hopefully I'll be able to get through all of the questions. I'm very conscious the last time we didn't get through all of the questions because there were so many that come through, so we'll jump through. If you do have ISA questions specifically, I will try and tackle them, but I'll probably just try and move through them as quickly as possible as well. All right, okay, let's have a look. Right, okay, so we've got this question right here, which is from Harry, and I need to make this a little bit bigger. Bear with me, guys, because I can't see that. And here we go. Hi, Pete. I have a question. As a beginner investor, do I buy the same shares each month? How do people do monthly investing? Sorry for the silly question. Not a silly question, Harriet. If you are investing, you're a first-time investor, it depends on how you're investing. I assume that you're probably alluding to using someone like Trading 212 or someone like that to invest. Typically, what you would do is you would have a number of companies that you're interested in, and then you would literally just buy those same companies on a monthly basis. So you almost, in Trading 212, build yourself like a pie, for example. And then once you've built the pie, you would have your money go into that group of companies if you've done a direct debit into Trading 212. So that's how most people would typically do it if they are indeed investing in individual companies, right? If you're like me, yes, I hold trading 212, but I also invest in index funds and ETFs. So with an index fund and ETF, the companies are already pre-selected for you. So essentially, when you send money to the Hargreaves Lansdown or Vanguard, whoever it is that you choose, the money just goes into those companies. So those same companies that you selected that are part of the index fund or the ETF. So typically people would normally invest in the same company. So yes, thank you for that. There is a super chat here from Lisby. Thank you very, very much. Bear me 1 second. Let me see if I can actually get this. I'm using a different streaming service. Here we go right here. Let me see if there's a question attached to this. Lisby, if you do have a question, if anybody super chats, by the way, this really does help me out in terms of channel support. Maybe one that we spend here also worth my while as well. If you do want to super chat, want to fast forward or streamline, put your question to the front of the queue, you can use the super chat feature there as well. So thank you, Lisby, for that super chat for £5. Really do appreciate it. It does help me out. Right, let me just shrink this down a little bit, and let's see what else we have here. Kevin, how you doing, mate? Welcome. Cadelia, hey, how you doing? Right, we have got another question from, let's have a look. So many already. There is a question here actually from this bit. Could you please recommend a good stocks and shares investment ISA with a low minimum investment to open? Also, how are your dividends paid, by check or into the account? Okay, dividends first. Your dividends, Lisby, will be paid into the account. So if you've got your account with Trading 212, it will be paid into your Trading 212 account. You won't get it paid by check, always into your account. A good stocks and shares ISA with a low minimum investment to open. Low minimum investment to open. I'm just trying to think. If you go with Vanguard, you've got to put 500 quid to start off with. Depends what you mean by low. But £500 is the minimum with Vanguard to open. Free trade. I don't think there's a minimum with free trade. If you want to buy and pick stocks yourself. If you want to pick one of the other providers that do this for you, though, then Moneybox maybe. You can start there with as little as £1. So a couple of options for you there. I would also check out Wealthify. I can't quite remember what their minimum is, but I think it's pretty low. So Wealthify, Moneybox, Free Trade maybe. Who else? I think Nutmeg has got a high one. So yeah, so Moneybox, possibly Wealthify, Free Trade. Those will be three that I would say could be good bets for you, Lisby. So let's see what we got here. There's a comment here. I wish I got paid 20k every April. It would be much better. Yeah, listen, look, at the end of the day, I mean, it's a free thing that the government allows. Well, I wouldn't say it's free because obviously it's your money that you're having to invest, but they are allowing you to invest it completely tax-free. So it is, I'd say with this one, right, have this mentality when you look at this. Have the mentality of making sure that you pay yourself on a monthly basis. And what I mean by that is, you know, everybody goes to work, gets paid a certain amount every single month. Make sure that you put aside a certain amount where you pay yourself. So if it is, you know, £200, £300 that goes into an investment or into your ISAs, for example, pay yourself. I mean, if you're able to be lucky enough to get, you know, 10,000, 15,000, £5,000 into an ISA, now that adds up over the years, and it gives you, you know, a safety net. It gives you the ability to, you know, plan for a house deposit, so on and so forth. So yeah, it will be very, very nice to get paid 20k. I mean, there are some investments, by the way, depending on what level of investment you make, that actually will give you a check back from HMRC, you know, every single tax year, as long as you hold it for the qualifying period. So those things those things do exist. Let's have a look at this. I bought Futu at 30. It's run right up. Sadly, I only bought a very small portion too. It's now at 130. Had a high of 200 since I bought. Is it worth averaging up? I'm currently 200% up. What do you mean exactly, Vibes? Averaging up in what way? I mean, are you looking to buy more? Just elaborate a little bit for me there, please, mate. We've got one here from Tio. I think this may be more of a comment than it is a question. Brokers like Free Trade show different fees on their app and on the fees and charge on the documentation they provide for the stocks. Which one do you rely on? You should always rely on the documentation they send you, because if they do have any additional costs over and above what they publicize, everything has to be in the documentation. So I would rely on the documentation because that will be a full breakdown of all the costs. But having said that, though, there shouldn't be too much difference between what they show on the app and what you get through in documentation. It shouldn't be that much difference at all. Kevin, T, what does it mean when my pension says current earnings? I forgot to ask on the pension podcast last week. What do you mean current earnings? I'm not sure what you mean by that, Kev. Just let me know. Who are you with, first and foremost? I'll need to see documentation to know what you mean by that, because I've not come across a pension where it says current earnings. It will always say current value or transfer value, something like that. So let me know. Hey T, how you doing? Cordelia, there may be a little bit of a follow-up to what Cordelia is asking here. I did that, but I timed it wrong. Best to invest when shares are down. Yes, I mean, look, it's really, really hard to time the markets. Obviously, we say time in the market rather than time in the market. You know, time in the market rather than time in the market. The important thing really is just to form the habit to make sure that you are investing on a regular basis. That's the most important thing. Over the course of time, pound cost averaging really does benefit you. So don't be too fussed about whether the stock is at a low price or a high price. If you believe in the stock that you're looking to buy, then just continue to buy it all the way through, and the pound cost averaging should hopefully help. But certainly when markets are depressed, it does help and it does make sense to buy stocks low. But obviously, just make sure that you understand what you're buying, because obviously capital is at risk and things can be very, very volatile as well. Sorry, I'm late. If I want to invest in individual shares and index funds, what's the best platform apart from 212? There aren't that many that will allow you to do both. So Trading 212 will allow you to do that. Free Trade probably allow you to do that as well. Well, actually, index funds on Free Trade, maybe not index funds specifically, but they do allow you to access some funds on Free Trade. Then the other one that I would think of would be Hargreaves Lansdown, but obviously you've got the £11.95 fee for buying shares with them, the share dealing fee, which is quite steep, considering that you can do this stuff commission free right now. If you want access to a wide range of ETFs, then eToro is a good shout as well. So there's a number there. There's Hargreaves Lansdown, eToro, Free Trade possibly. But most other providers, Vanguard is purely index funds, ETFs. You don't have the ability to buy individual stocks. And then all of the Robo or Moneybox, Wealthify, those kind of people, they do everything on your behalf. So you don't have the autonomy of buying individual stocks yourself. So yeah, so just a few there for you, Lee. Alvaro, what's the best way to save for a house deposit? Should I cash out my ISA or... let me see if I can find the or, mate. 1 second. I can't find the or. Well, I think I kind of get the gist of it. You need to be saving into a lifetime ISA is the easy answer to that, essentially. Lifetime ISA will mean that you get a bonus from the government to help towards your deposit. Okay, Rasuti. Okay, hi P. I've been day trading stocks on Trading 212, but I find their platform has a delay. What other platform would you recommend for day trading? Thank you. Right, okay, so you can trade on eToro. Probably the best one that I found you probably know what you're doing when you say day trading, so you'll understand how important it is to have access to kind of like live data, like news, tweets, being able to see all the information and charts, and obviously be able to customize your candlesticks and so on and so forth. The video's not out just yet, But Fineco Bank, who I reviewed back in January, they have a really, really great tool called a Power Desk. It's a professional tool for traders, essentially. I would definitely recommend going to check them out. There is a link in the video review that I did for them. They are giving away 100 free trades at this point in time. If you're looking to buy US stocks, it's $3.95 a trade. If you're looking to buy UK stocks, it's $2.95, which it does cost you something. But trust me, the tools that you're going to get with this is amazing, mate. It's really, really, really good. And you get the ability to trade in euros, dollars, pounds. Essentially, you get a bank account with a number of 21 currencies tagged to it. So you can trade across the UK markets, US markets, Australian markets, Canadian markets. It's very, very versatile. It is a professional grade tool. So I definitely go and check them out, see if it's actually worth your while. But they are doing 100 free trades at this point in time. I'll see if I can find the link, and I'll post it in the comments here very quickly for you. But yeah, they're really, really good. I'm going to be I've used them a little bit. But the Power Desk, I've got the video for that coming up fairly soon. And yeah, it's a really, really, really good tool. I'm just going to post that link in there. So go check them out there, mate. Right, let's have a look. I've got to go back up. Bear me 1 second, guys. There's quite a few questions in here already. Where are we? Okay, so Money, Whiskey, and Coffee. How you doing? Do you have any idea when Trading Team One still start accepting new accounts? You know what? I have no idea. It is weird that they've taken this long. I mean, it feels like it's been 7, maybe 8 weeks or something like that now. I think they've got challenges that they need to address. Certainly from an operational point of view. I think someone's already mentioned in the questions already that there is a delay that they've seen when you're looking to place trades. You can't have that. I mean, look, if you're trading with people like Fineco or eToro, there's no delay. Like, it's executed immediately. And whilst they'll say that it's not really a problem, actually it is a problem. So with the growth that they've seen over the last 12 months, and I did a video talking about, the growth that they've seen, I think they're going to have to take their time in making sure they get the operational side of things right. I mean, they're already introducing fees right now. So I wouldn't be surprised if there is going to be a big change in the offering, specifically around, all right, there's an FX fee now of 0.15% or something like that they've now introduced. They're now introducing a fee for transfers or money into the account over £2,000 or 2,000 euros. So I think there's going to be more and more stuff that they'll need to change. But from an operational point of view and systems point of view, they're probably doing a little bit of a overhaul to try and streamline things. When they're going to begin opening new accounts, though, I don't know. I think it's not necessarily common for a provider to take this long, but they've had great success. So I'm sure that they're just reevaluating. But when they're going to begin is anybody's guess, mate. Anybody's guess. All right, there's one here from Esther. I recently opened structured shares item for the first time. I've chosen to invest some money in the emerging markets index fund, which is highly volatile. Should I be more conservative with my money as a first-time investor? Well, the answer to that from the top is possibly. It depends what your risk profile is. This is why I always say to people, you just can't jump into this and just be like, I'm going to pick this one. Like, you have to have a reason why you're picking it. There has to be logic behind why you're picking something, why you're going into an investment of some kind, right? Like, if you're investing, you don't even know whether you're a cautious investor or an adventurous investor. That's a recipe for disaster. You could have gone into something that may not even be suitable for you at all. I mean, if you've just gone into the emerging markets with nothing else, I would seriously question why you started there and your reasoning behind starting there. And this is where coaching and things like that really come into play, because we have to understand first and foremost, what level of risk are you comfortable taking? Like, an emerging market is a high risk strategy, especially if you're 100% in, you've got no diversification. And this is the thing, a little knowledge can also be very, very dangerous. So possibly you should have taken a more conservative and should take a more conservative view, but it's hard to say for certain without knowing what your actual risk profile is. Are you 10 out of 10 on a risk scale? Are you a 5 out of 10? What is your default position? Then we can start having a conversation around, okay, what are your investment goals? How long are you looking to invest for? And then we can start getting you comfortable with, if you're going to go for an emerging markets index fund, what you could expect, because it's very, very volatile. That's the kind of stuff that I do with coaching. So it's hard to give you a very straight answer in terms of, yes, you should be, possibly you should be. I don't know, because I don't know your circumstances and I don't know what your risk profile is the honest answer that I can give to that. All right, hi Pete. If I start investing as a beginner using ISAs, when should I switch to standard investment account? Is it when my allowance finishes, or should I use both at the same time? It depends on your circumstances. You probably want to use all of your ISA allowances first and then move on to your general investment account afterwards. So if you got 25K, put 20K into your ISAs, put 5K into a general investment account. And then what you would then do is you would feed that money from the general investment account into the ISA the following tax year. That's typically how you should use it. That's the best practice in using it. Don't, use your ISAs first. All of it. Sorry, guys. All of it is the most important thing you should do. All right. Let's have a look and see what we got here. Hey, mate. Angry Ed. Okay. If you're in it for the long run, why is it worth diversifying? I.e., why not just do 100 stock market world fund? Is it really? Is it worth doing 60-40 in market/bonds? What do you do? What I do is not necessarily what you should do. So what I do isn't really relevant to the question. I invest for the long term, and I know that my natural risk profile is balanced and not 100% adventurous. So I invest according to my risk profile and my investment time horizon. Now, is it worthwhile investing in bonds? Yes, it is, because it depends on how long you're investing for. Now, different people have different interpretations of what the long run is. For some people, the long run is 10, 15 years. For some people, it's 30 years. For some people, it's 40 years. There is an argument to say for 40 years, you could afford to go into a 100% stock market fund, world fund, right? But that isn't going to be the same for everybody. Everybody's interpretation of long-term or long run is very different. For some, long run is 15 years because they're approaching retirement, in which case they will need an element of bonds and an element of security to offset. So it really depends on your circumstances. Diversification is all about making sure that you're able to manage your risk. If you're in a world fund, you're diversifying, essentially, but you're diversifying within your equity basket exclusively. Now, there are different asset classes, right? So you can use asset classes to also diversify. So it really depends on where you are, what you're doing, what your goal is, what you mean by long term. If your long term is 30 to 40 years, then technically speaking, yes, you could afford to go 100% into stocks. If your idea of long run is 15, 20 years, then it may not be appropriate for you to go 100% stocks, depending on what your end goal is. So all this kind of stuff, mate, there is no one size fits all for anybody in any way, shape, or form. You have to do what is right for you based on the reasons why you're investing, which is why it's very, very difficult for me to say, yeah, go and do this, because that would be me giving you advice. And for me to give you advice properly, I need to know your personal circumstances. So I can only give generic answers. But, in the scheme of things, those are the key considerations as to why you diversify. Diversification is all about stacking the odds in your favor, making sure you've not got all of your eggs in one basket. If you're investing in a 100% stock world fund, right, you are diversifying within your equities asset class across different sectors, across different geographical regions across the world. Now, the opposite to that would be to put all of your money into the US markets, into the S&P 500 or the North America fund, right? That isn't diversification. That's 100% equity investing in one location. Huge concentration risk, massive concentration risk. So you're diversifying going into a world fund anyway, but it's definitely worthwhile holding bonds in your fund, depending on what you're investing for and the reason why you're investing. Let's have a look. Good question. What's your opinion on CCIV and Lucid? Good investment for the future and a rival to Tesla? Personally, I'm indifferent. When they produce the vehicle and they're selling the vehicle, then I'll take a punt on them. Until then, I'm not necessarily looking at them. I know that many people are looking for companies they can get into really, really early. I just don't take that view. That's my personal view. I personally would rather have a company sell a product and actually have something that they're selling that people are interested in physically, that you can see, that you can touch before I invest it. My style of investing isn't necessarily getting in at the ground up with companies that have gone to market or are talking about a product that they're going to develop. Like, if someone came to me on the street and said, "I've got a business that is going to do this," I'm not going to give them my money. Like, show me what you're going to make. Like, show it to me. Sell it to somebody. It's the same. The same principles apply for me. Are they a good investment for the future? Possibly, yes. I mean, look at the EV space. The question is, are they going to be able to make strides in the EV space? The specs on the car, everything in the investors' prospectus, there were huge question marks. They focused on the stuff that would excite people, but there's no autonomous driving. There's tons of stuff that's missing. They're talking about the range and stuff, but actually that's not going to be available on the car that they're actually going to release. That's going to come maybe in 2 or 3 years' time after the first model's released. So possibly good investment, yes. Rival to Tesla? No, I don't think so. No, I think they'll be too far behind. I think, who are the main rivals to Tesla right now? Possibly NIO as a possible example because of the Chinese market, possibly. And that's pretty much it. I think Tesla have always got the huge advantage on most of the EVs that are out there. That doesn't mean that there isn't space for others, but CCIV and Lucid specifically, I think they've still got a long way to go. Personally, for me, to put money into it, because I'm not interested in getting in, day one, high risk. Something might go wrong. I'm not saying that it will, but it's just not my style of investment. But I know that many people do want to get into those companies very, very early on. I need to see a product. I need to know that they're selling it first. Right, okay. Let me just check my other screen right here. Bear me 1 second, guys. Okay. All right, okay. Can you convert your ISA across different financial years, i.e., if I have a cash ISA in 21, can I convert it into an ISA? You wouldn't do that. They just roll on, mate. So your ISAs just roll on. So any ISAs that you had this year will just roll on to the next year, and you get a new allowance every single tax year. So you don't need to convert it. It will just simply just roll on. Let's look at this one. Can you explain why eToro virtual account stocks have disappeared? My available balance now shows 0. I have no idea. I don't work for eToro. Let's have a look. Buying more stocks. There's a comment there. There's a follow-up question here, actually. Let's have a look at this. Can you have a cash ISA and stocks and shares ISA at the same time? Collectively, they have to make up 20,000. Yes, that is absolutely correct there. Right, let me just see this. Vibes. I think that this is a conversation. Buying more stocks. All right, let's have a look at this. So the first comment is buying more stocks. As I said, it's 52-week high. It's $200. I've got a super early $30, but it's worth buying more stocks as it will eat away my profits, but it has the potential to run right up again. But it's a big gap. It's top, mate. Completely down to you. Can't tell you what to do, mate. If you think that it's a good investment, if you think that it's going to be worthwhile, you can get a profit out of it, then you should. But at the same time, you have to understand that you're going to be taking a risk either way. So do you want to take your profits, cash out, or do you want to buy a little bit more in the hopes that it goes up? Nobody knows what's going to happen at the end of the day. So again, with this, whatever stock this is, did you do your research on that stock? What reasons do you have to think that the stock price will go up? Because surely if you're buying it, you believe it's going to go up even further. So what are the reasons behind that? These are all key questions. Like, investing is not about guesswork. It is being strategic, and it's actually being methodical around what you buy, when you buy it, and the reason for which you buy it. and also trying to be, dispassionate in your views as well. So I don't know, mate. It's a tough call. You've got to do what you feel is going to be right for you. Let's have a look at it. So this is a comment around Moneybox. Yeah, just got current earnings. Okay, so you're with Moneybox. I'm with Moneybox on my personal pension. It's got the amount that I have in it, and then just underneath, it's got earnings, and it's currently. I have no idea. That will be a question for Moneybox, mate. I've not seen a pension that says current earnings. It will normally say current value, and that may be their iteration of that. But that's one for Moneybox, mate. Let's have a look at this question from Jonathan. Is there any benefit in having multiple stocks and shares ISAs? Well, if you're contributing over a number of years and they're with different providers, you're going to have multiple stocks and shares ISAs anyway. There's nothing wrong with having them. The benefit is you're going to have a ton of money stacked up in stocks and shares ISAs, which will be completely tax-free. So that's the main benefit, effectively. Right, question from Governor. Okay, I'm new to stocks and shares ISAs. I don't know much about the market, so would you recommend I go for a ready-made portfolio? I'll be investing £400 per month for 20 years, hopefully. Thanks. Yeah, if you don't know much about anything at all, you're just starting out, you are probably better off going for a ready-made portfolio in opposed to trying to guess and pick stocks that you're not necessarily knowledgeable about. It's like walking into a casino and putting all of your money on red without really any reasoning behind it. You need to be careful, mate. So, to start off with, you probably want to go for a ready-made portfolio. That means it's going to be done on your behalf. You've got a team or someone who's built it, who knows what they're doing. Yes, the caveat to that is you're going to pay fees for their services. But to give you the peace of mind to know that you're not just trying to pick companies on your own, then yes, if you know nothing, like nothing at all, go for a ready-made portfolio. Do not try to start picking companies if you don't understand what you're doing. You can change your tact later on. So if you've started investing and you start picking up knowledge and you kind of understand what to look for, how to research these things, then yeah, you can change your mind a bit later on. But to start with, be cautious. Caution over exuberance is what I always say if you're a first-time investor. It's very, very easy to get excited about the possibility of, investing because it's sexy and all that kind of stuff. But, it is, you need to be careful. You do need to be careful. Andy Knox, hi Pete, would you recommend St. James's Place? Really good question. I actually used to advise with St. James's Place. They are a good outfit. They are very, very good indeed. Great organization. They are expensive though, mate. Your ongoing fees are probably going to run you 2%. So if you're getting 5% per year, they're going to take 2% of that. So you need to ensure that if you are happy to pay them 2%, that you're getting the service that is equivalent to the 2% fee, which can be hard to quantify. Can be, but you have to be happy with paying a 2% fee, potentially, or up to 2% fee for their ongoing service. There are some circles that will argue that their performance is really bad in comparison to other advisors that you might seek to use. And that's because they are vertically integrated. They have their own products. So when you go and see them, you're buying an SJP fund, essentially. So they're not hunting the entirety of the market for the best solution. Like, you go and you're going to get one of their things. That's it. Like, some people argue that it's trying to put, square holes in round pegs, right? Or round pegs in square holes. So they are very, very good as an outfit, but they are known to be expensive. So if you're looking at going to a financial advisor, maybe compare them to an independent financial advisor. So they are restricted. What that's restricted basically means is that they will offer you something that is, they're restricted to their own products. They can't go It's like going to a supermarket, right? And going and buying Tesco's only brand and not looking at anything else, right? That's essentially what they are. They're Tesco's only brand. You don't get anything else. Whereas if you go with an independent financial advisor, they will go through the entire supermarket, including, well, they won't go and look for the Tesco's brand stuff because SJP won't allow independent financial advisors to have them. But they look at more options for you. So they can be cheaper in some instances. But yeah, I would say if you're going to have a conversation with them, compare them as well to an independent financial advisor. If you need help trying to source one, then message me on IG and possibly I might be able to put you in touch with a few. So yeah. Let's see what else we got here. Dijon, hey Dijon, what's going on, man? All right, what's the best high percentage of consistency index fund for compound interest? Why wouldn't everyone just use the best instead of others which don't perform as well? That's because funds, mate, will have different performance cycles, mate, at the end of the day. One fund might do really, really well over a period, then the next fund will do better. And you've got to remember that oftentimes when you talk about funds, there are different iterations of funds as well. So they might bring out a version 1, then have a version 2, which is slightly different. And that version 2 might perform better than version 1. It also really depends on what's going on at any given time in the economy, globally, so on and so forth. So yeah, you'll have like good performing funds within a period, but that doesn't mean that they're going to be performing well in the future, which is where the old adage goes, you know, past performance is no indication of future performance because things change, circumstances change. So highest, the most consistent index fund is subjective. It depends on how you slice and dice the data. It depends on what your selection criteria is. You know, S&P 500, the VUSA, for example, very, very good fund. But, you know, you look at some of the other funds within Vanguard, they performed even better than that, you know. So it really depends on your selection criteria and what you're looking for. But, you know, these things, they do change. They do change quite a bit. What's your opinion on money expert Martin Lewis? Do you think he's full of... No, I mean, I think Martin Lewis, he's really good at like the general consumer type stuff, isn't he? In terms of some of the stuff, you know, he does skirt the line between like advice and non-advice though. He skirts that really, really closely. And sometimes I know financial advisors who just don't like him because some of the stuff that he says, he shouldn't actually say, but he says it anyway. But he gets away with it because he is Martin Lewis. I think ultimately his intentions for doing what he does is great, and I think that's the most important thing. You can only judge people by their intentions, right? His intentions of what he's actually trying to do, empower people's, you know, make their money go further. You can't fault a guy for wanting to do that. You know what I mean? It comes from a good place at the end of the day, and he's built a very successful business off the back of it. I really like what he does. You know, in an ideal world, I'd love to be his version, but for the educational side of what I do here around, you know, investing in the stock market and so on and so forth, trying to get people, you know, in the position where they can start to invest and start to build for the future. Because it's all very well and good saving money on your Tesco shopping and stuff, but, you know, what are you going to do with the money ultimately? How are you going to build for the future? If you save £20, £50 per month on your food and shopping, where does that money go? Does it just go on holidays, or do you invest it and try and build for the future? You know, I think there are steps, and he takes care of one step. There's a step missing beyond that. Right, there was a question here. I think maybe this is a comment actually. Yeah, I mean, the power desk is really, really important. The video is not live just yet. It's coming in the next couple of weeks or so, but the power desk is awesome. It's really, really good. It's professional grade stuff. All right, there's another question here from Lisby. Let's have a look. Hi Pete, is that ISA booklet you showed available? Which, right, that one wasn't a booklet. It's a workshop that I'm doing next Saturday, which is going to cover everything that I spoke about in a workshop. So it's going to be hosted on Zoom, and it will basically go through. It will be hosted by me, I will basically go through the foundations of ISAs, what they are, how they work, why they're important, where they fit within your financial plan, within your investment plan. I'll talk through the rules, more importantly, the different kind of ISAs they have, when you might use each of them. It's going to be quite an in-depth sort of workshop. So it's going to be next Saturday between 6 p.m. and 8 p.m. So tickets, it is a Zoom online meeting. I'm going to record it as well. So I've done a number of these in the past and through last year. And oftentimes people want to attend workshops, but something else comes up. So what I tend to do with all of them is I record the session. Then everyone who buys a ticket will then receive a link to actually view the recording afterwards. So I build a slide deck, I talk through everything, and there'll be plenty of time for questions as well. I'll post the link if anyone is interested in joining me for that next Saturday. I will literally just post the link in here. So feel free to have a look at getting a space, but it's going to be quite in-depth. It will cover everything that you essentially need to know about ISAs. So there's the link right there, guys, if you wanted to book on. Let's have a look and see where we are. Let's go back up. What's your view on ESPP programs for employees? Employee assistance programs, I'm sure that means. Verify that for me. Employee assistance programs. I mean, they take different shapes a lot of the time. I think they're great. I think ultimately employers should do more for the employees, particularly when it comes to finances and financial well-being. I've done corporate workshops last year, speaking specifically about that. A lot of them are reluctant to talk about finances in the workplace because they don't feel it's their bag or their responsibility to do that. But actually, the research shows that actually it is, and there are business benefits to them providing some financial training, financial education to employees. I did some stuff for a number of companies last year where we talked about, recession-proofing your finances. We go through a full session, give practical tips, give downloadables, all that kind of stuff. I think the programs are good. I think there's been a lot of focus on mental well-being, but they completely forget and look over the fact that there is a huge proponent of poor financial well-being that impacts mental well-being. So in other words, if you're stressed about money, then you're going to, I think the stat was that your people who are worried about money are 4.5 times more likely to be going through depression and 4.8 times more likely to actually be suffering from anxiety. Those are real stats, real figures. So employers could do more for their employees. But I think, number one, there aren't that many companies that are actually out there speaking about this specifically, which is one of the areas that I hope to branch out into. But yeah, I mean, they're great, but I think more could be done. Is the Fineco stocks and shares ISA a good one? Yes, it is. I've not had a look at it specifically myself, but it will work the same as most ISAs generally. So they've literally only just launched that, from my understanding, actually. So it is a good option. Maybe do a comparison. Again, you'll be able to buy ETFs. You can buy individual stocks with them, and all sorts of stuff. And again, because you open an account with them, you're able to invest and trade from your current account. So for example, if you wanted to invest and buy UK stocks, American stocks, you could do that all within the platform that you get as part of your account opening process. And because it has different currencies attached to it, so i.e. you loading pounds, it automatically then gives you a euro account and a US dollar account. So it saves you having to do that conversion from pounds into US dollars for American stocks, because you've got a US dollar account bolted onto it. Little things like that make it really, really, really good. So yeah. Okay, in your opinion, getting an average of 8 to 10% growth on a stock and shares ISA with Moneybox and being charged 1% reasonable? I think about changing to a new provider. Mate, look, that's a hard one for me to answer. The real question is, who else is going to give you 8 to 10%? Realistically, who else has done 8 to 10% this year? If you can find those ones, then you essentially then have to go and compare what they charge, and make sure that you're not comparing apples and pears. So, i.e., don't go and have a look at Moneybox and then Vanguard, because they're not the same service. Moneybox are doing it all for you and handling it for you. So when you're comparing them, you need to compare Moneybox, Wealthify, Nutmeg, Plum, and another provider, Money Farm, for example, who is doing exactly the same job. Too many people compare Moneybox and Vanguard. They're not the same thing, mate. They're not doing the same thing. With Vanguard, they literally build something that you go and buy. You then have to deal with it yourself. Yes, it's managed, but you have to review it. You have to do the whole thing all by yourself. With Moneybox, they're doing the whole review. They'll send you statements, all that kind of stuff. They're doing the management in the background, right? So you're outsourcing it to them. With Vanguard, it's subtly different, but it's not the same thing. So the question is, who else is going to give you 8 to 10% for exactly the same service that you've got? If you don't need the service that they have, then you could say, okay, you know what, I'll go to Vanguard and pay less, because you're not going to pay anywhere near 1% with Vanguard. It'll probably be what, 0.22. You can have one of their active funds at 0.78%, for example, right? So it's a completely different service. You need to make sure that you're comparing apples with apples and not apples with pears, because people talk about cost all the time, and it drives me nuts a little bit, because sometimes it's not the same. It's not the same thing. Like, you can't compare Trading 212 with Moneybox or Wealthify. You can't even compare Trading 212 with Vanguard. Very, very different services. Very, very different services. So it's important to ask yourself, is it worthwhile to you? Cost is only an issue in the absence of value. So if they weren't doing it for you, if they weren't, managing, having this money in a fund for you, and you have to do it yourself, with the time that it takes for you to go and pick those stocks and manage it and monitor it and all that kind of stuff, would that trade of time and effort and possibly the upskilling and the learning that you need to do justify 1%? If it does, then yeah, maybe you want to do it yourself. If it doesn't, then it's saving you time. Like, time is precious, mate. Is 1% worth the time that it's going to save you so you can do things that you like doing? Possibly, but that's not for me to say. So it's really, really important to bear that in mind. But, compare apples with apples and not apples and pears. Mark, the UK being a finance country, why don't you have a decent choice of trade trust investment platforms? We do, mate. There's loads of them here that we've got access to. Trading 212, Free Trade, eToro, Orca, Eureka. We've got tons of them. Interactive Investor, AJ Bell, Hargreaves Lansdown, Investec. We've got tons, mate. There's a reason why the UK was, and currently still is, arguably the finance hub for the UK. Let's have a look at this one. 100 messages. Great, guys. Thank you. Let's see what we've got here. Great content, beat. Love the channel. Is it good or bad? Is it a good or bad business call to only invest in companies and industries I know about? No, it's a good place to start. Let's put it that way. I think it's really important, if you're going to invest in companies individually, like buying individual stocks, you start with something that you know, because at least that way you have experience, you have know-how in that industry. So you're more likely to be able to pick something that is actually going to be profitable, rather than going into something that you have no idea about. You don't understand how the sector works, and therefore how the companies within that sector actually operate. So it is a good idea to start with something that you know, and then you can branch out into other areas based on the stuff that you know and the common things that you'll find that are important within the sector that you understand. Loved your NFT video. Thanks, Lawrence. Me and 3 mates collaborated on a project and made 3 ETH on the first night. Good, mate. I mean, NFTs are very, very interesting, mate. Just looking at the applications across gaming, music, and art and stuff, it's really, really, really interesting. I'm keen to see whether the trend will die down or whether it will just continue to kind of boom. Because I think it's undeniable to think that over the last month or so, some seriously ridiculous things have happened in terms of, you know, people like $69 million for like a piece of digital art. Like, it's nuts. It's absolutely crazy. But it'll be interesting to see how it progresses from here and how it expands and stuff. So well done, mate. Let me know what you've built. Let's have a look. Any take on Fineco? Yeah, so with Fineco, I did review them. I actually did a bit of a partnership with them. There's a little bit of negative feedback that I have had within my private members group, actually, in the fact that, you know, trying to get to speak to somebody, not that it's been difficult to speak to somebody, but that actually, because they're an Italian bank, that the Italian accent is quite strong. I think that is a fair comment to be made, but at the same time, like, you know, you speak with people with all different accents these days. It is, you know, very diverse sort of world now. So I think whilst it might be a little bit of an annoyance, it is one of the situations. But, you know, I like the platform. I like what they do. Just being able to simplify things in terms of an account with investing and trading, then the Power Desk stuff. I mean, I didn't know that they had the Power Desk stuff until like 2 weeks ago. I started to poke around with it, and it's really, really good. It reminds me of the Bloomberg terminals that we used to have when I was working for a discretionary fund manager. And, you know, these things, they pay thousands and thousands of pounds for licenses per person, per user. And what they've essentially done is they've replicated that, but put that into a retail package. And they've made it available as part of the account opening package, like literally for free. I mean, it's amazing what they've done, how they are able to afford it. Well, they're a big bank in Italy. They're huge in Italy. It really is. It's a top. I was really, 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 really impressed by it. Really, really impressed with eToro and stuff. You can, you know, have a look at the chart and you can get into the candlesticks and stuff. But you can't really pull up. You can't customize the charts. You can't pull up like proper real-time tweets, real-time news. And I'm going to do a video which will be out due in a couple of weeks' time. You can actually source where you want your news to come from. So if you want Reuters, CNBC, Fox Business, CNN, BBC, you can actually filter your news outlets. So if there's one in particular that you like listening to that you rely upon, you can click that button and news from that provider will come through specifically. In terms of trading, for traders and investors, if you're serious about it, it's a really, really, really powerful tool. Really powerful tool. Timbo, hey Pete, what do you think about advisors using the ARC private client indices as a benchmark for performance? Everybody does that, mate. Everybody does. I mean, ARC is just a standard practice at the end of the day. So yeah, it's a standard practice within the advisory community to use ARC because everybody feeds into it. Everybody reports their data. So it gives you a really good view of what most funds have essentially done. So it's a good benchmark. Kevin, yeah, I don't want to lose money. I hired a professional and he lost my money. I could not live with that. Yeah, but the thing is, mate, if you hire a professional, and this is what people don't realize sometimes, is if you hire a professional and they lose your money and it's because of negligence, you can take them to court and actually get your money back. Like, people don't realize that. So why do you think advisors have to go through so much in terms of compliance and jumping so many hoops? It's because they are liable for their advice, which means that if anything goes wrong, you've got a port of call to go back and say, you did this wrong, and they have to cover your money. A lot of them take out insurance for this kind of stuff. So, like, again, a little information can be quite dangerous sometimes. Yes, advisors have a very, very poor reputation, and rightly so, because some of them, I've met a few of them that have been right old scoundrels and just have no interest at all in what is best for their client. But as always, there are always bad apples in a basket. That it doesn't mean that all of them are bad. And as much as I've met some that are just proper scoundrels, there are tons of them that I know that are very, very, very good, very, very skilled at what they do. And frankly speaking, some of the tools that they have access to, you would never be able to get hold of as a retail investor. Things like cash flow modeling, all that kind of stuff. The tools that they use these days are extremely sophisticated. And that is important because they are underwriting their advice. So these tools are there to basically stress test what they're advising you to do to make sure that it has the highest propensity for success than failure. Because if it does fail and it's because of negligence, they're in a hole for it, essentially. So it's really, really important to bear that in mind when you're looking at, hiring professionals or not. Any thoughts on Cardano? No, I haven't got any thoughts on Cardano at the moment. How do I start a hedge fund? That's not a question for me here. Let's have a look. Pete, do you have a home charger plug for your Tesla? Yes, I do, but I don't use I don't charge at home. I've got a supercharger about 5 miles from where I live, so I charge there because I've got supercharging for free for life with the car. There's a couple of conversations going on here. It's a good question here about Warren Buffett from Kevin. Do you think the main reason why he got so rich is because he started so early and he's so old? No, he's very, very good at analyzing stock. He was a thought leader when it comes to analyzing stock, picking stocks, and actually just invest it. He reads a lot. His knowledge is the reason why he's so rich, and because he did start early, but he's very, very good. He was a thought leader in analyzing stocks, so on and so forth. What is it? So ESPP here, employee stock purchase. Yes, stock purchase is great. Obviously, make sure if you're working for one of these big companies, yes, then absolutely. I mean, if you're working for someone like, Verizon or someone like that is proper, a leading company, then absolutely. I thought you meant employee support programs and stuff like that, because that's a thing on there. So yeah, but make sure that you understand the options that are available to you. A lot of them will say that you can purchase the stocks and they'll give you a discount and stuff like that. But make sure you read through all of the details. Right, okay, I'm going to give this another maybe 5 or 10 minutes or so, guys. So see what we can get through. Hey, I already invested in eToro without having an ISA account. Can I make one at the bank? Then rather on when I withdraw my money into the ISA account, will I have to pay taxes? All right, let me just get this again. Can I make one at the bank? Then later on, when I withdraw my money into the ISA account, well, okay, so you've got an eToro account which you don't have an ISA. So are you saying you want to withdraw into a bank account then open an ISA? You would have already paid tax on the money anyway. So you won't pay any tax. Well, you'll pay tax if you've had any capital gains and you breach your capital gains allowance. But most taxes should be accounted for when you factor in your allowances. So you shouldn't have any additional tax to pay as long as you haven't breached any of your capital gains allowance, or for example, if you've invested with eToro and it's gone up and you've used your capital gains allowance, there shouldn't be anything else to pay. Okay, this is a good one. This is a credit card question from David. How do I get a credit card as a student? I'm looking to build credit. However, the eligibility checkers say my best chances being accepted is 3 out of 10. Where are you looking at this, David? One thing I'd probably recommend that you do is go and download ClearScore. It's an app in the App Store. Go and download that. If you've got this already, you may have. It will give you a list of potential providers that will accept you for a credit card based on your credit score. It's not always 100% spot on, but it will score you out of 10, for example, or it will say 90% or 95% chance of acceptance. You probably want to do that. So you want to download the ClearScore app out of the App Store and use that. That would be my suggestion. Give it a little bit of time though, because when you download the app and you fill in your details, it updates every 30 days or so. So when you download it, if you download it today, it probably won't give you any recommendations straight away. It will probably give you a recommendation in maybe 2 in the second month or the third month. Then once you've got the recommendation, try and go for the highest one, or at least contact them and say, look, you want to apply for a credit card, and see if they'll do a soft search for you, not a hard search. Because if you do a hard search, it leaves a mark on your credit report, and that could then knock down your score even more. So you want to go for someone who can do a soft search for a possible acceptance. But Go and get the Clear Score app, mate. It's free. All right, okay. If I don't want to withdraw from a trading platform and exceed the yearly capital gains allowance, do I still need to pay tax on the gains made over that year, or is it only due once you withdraw into a bank account? Well, technically speaking, you should be declaring any of your trading or investment profits every single year with a self-assessment with HMRC. Technically, you don't pay capital gains until you actually realize it, but that does not negate the fact that you have to do a self-assessment return anyway. So do your self-assessment return. If you don't know what you're doing and you are breaching the capital gains allowance, you need an accountant, would be the easy answer. Well, look, the S&P 500 is really, really good because it's the biggest market on the planet, essentially. But what I'm trying to say there, mate, is that sometimes, right, you might have the S&P 500. So, for example, right, if you look at some of the emerging markets for last year, outperformed the S&P 500. But consistently, over the last 15 years, what market has done the best? S&P 500 globally, right? But they have their periods when other markets might outperform. So, for example, emerging markets last year outperformed most Western markets because they got out of coronavirus a lot sooner than everybody else did. They didn't have the hit on, the slowdown of their economies as much as the West did. So it really depends on it depends on the times. It depends on what's going on at the time. Nobody knew coronavirus was going to come along and knock everybody for six as it did last year. So it's really just about, when you invest in this stuff, it's about conviction. Like, do you think it's the best place for you? The S&P 500 historically has always performed extremely well. Does that make it the absolute best in the world at every single turn, every single quarter, every single year? Possibly not, because we don't know what's going to come around the corner, essentially. But historically, it has done extremely well. Let's have a look and see what we got here. Right, let's do one more. Let me see what we got. 1 second. I'm trying to pick a good one, guys. Bear me 1 second. There's a conversation going on here. So let me just find a good one. Okay, there's this one. Okay, this is from Joy. Hey, Pete, love the channel. Pardon me if you've already covered this. Any tips on maximizing ISA accounts? We don't want to open too many, especially between now and the new tax year begins on, and when the new tax year begins on 6th of April. Well, if you don't want to open different accounts, just pay the money into an existing one that you have right now. That'll be the easiest thing for you to do. It depends whether you've got cash ISAs or not, because obviously with cash ISAs, people often try to make sure that they can find the cash ISA with the highest rate of return. That may mean opening different accounts. Oftentimes it does. If it's a stocks and shares ISA, then you can argue that there's no need to go and get, sorry guys, there's the argument to say that you don't need to go and get a different stocks and shares ISA each year, because if you pick your provider, you're happy with it, then you should typically stick with that. But I know that some people do like to chop and change, but if you don't want to open too many accounts, just select one account where you're going to pay the money into, or you can simply just do a transfer. So if you find, for example, a cash ISA with the highest rate right now, better than the one that you've currently got, go and open or go and approach the new provider with a higher rate and say, look, you want to transfer X ISA to you and pay in more. It's probably a little bit too late now because we're so close to the end of the tax year. But that's what you could typically do. You could transfer into a provider with a higher rate if it's in a cash ISA, or even in stocks and shares ISA with a better service or better group of funds. All right, okay, cool. Sorry guys, haven't been able to get through all of them. There's still quite a few there. The next one of these will be in a couple of weeks' time. So let's just have a look at the dates. Where's my calendar? Yeah, the next one's going to be on the 4th of April. So I've got some really exciting stuff to come, actually. Trying to do something around side hustles right now. I'm going to do a collaboration with another YouTube channel, actually, on side hustles specifically, because I know that that's something that for many people is something that they do want to do. They want to have like little side businesses, things that they can have work for them to generate a different level of income, additional stream of income. So we're going to be doing a collaboration with another YouTube channel, which is going to look at Amazon FBA specifically. So there'll be a live session that we're going to do to culminate maybe 1 or 2 videos on the channel. So after the videos, you guys will be able to come on and ask him questions as well around how Amazon FBA actually works, how to set up, best practices, all that kind of stuff. That's going to be really, really exciting. Also going to have them on the podcast as well. So that's going to be something we're going to work on. So there's that. And there's a few other things that I do want to do. Like I said, the Pension B one was the first in kind of like a line of planned themed lives. So we want to do a few more of those, maybe do some stuff on trading, maybe some on crypto, maybe some on even buy-to-lets, property investing maybe. So yeah, those will come later on in the year. So just keep your eyes peeled for them. But guys, I appreciate you guys being here. Yeah, I mean, the next one's going to be a couple of weeks' time. I need to be a little bit conscious. Obviously, Sundays, I try to dedicate a little bit of time to do these on here. I might move these maybe to a more convenient time through the week and stream during the week, and maybe not be able to take as many questions as I do now. It's all about time efficiency for me at the moment. And because things have got so busy, I'm struggling a little bit with time. So things might change on the channel slightly in terms of these kind of sessions coming up, but I'll keep you guys posted with that as and when changes do happen. But yeah, the next one is going to be on the 4th of April. But guys, I do appreciate it. If you do want to get tickets to the ISA workshop, it's going to be next Saturday. Again, there is the link on the flyer right here, so you can put tickets at bit.ly/ISA-workshop. The tickets are $19.99. It's purely to make sure that you can actually just cover my time, because obviously it's a Zoom workshop that is going to last about 2 hours. I have to pay for the Zoom setup and everything like that as well. So just covers my time. But if you want to know everything there is to know about ISAs and how they all work within the financial planning structures and all that kind of stuff and all the rules, and really get a nice comprehensive breakdown of them, that's how you can book some tickets for it. But appreciate your time, guys. I will see you again on the 4th of April. Catch you soon.